everyone. Welcome back to another Cash Conference speaker event. We have Mr. Gonzalo Fernandez Dionis, and he's going to be talking about understanding the basics of stock valuations, which I think is really important in today's world when we're not focusing much on fundamentals, focusing on YOLOing our money. Stocks like GME and AMC, but he's going to be talking about fundamental analysis, stock valuations. Mr. Gonzalo, would you like to introduce yourself?
Yes, of course. Thanks, Julian Alexander, for having me. He was one of my best students about a year ago now. So my name is Gonzalo Fernandez Dionis. I used to be an equity analyst back in the days. I worked at Barclays and Royal Bank of Canada, focused on TMT, so technology, media, and telecom stocks. And my job was basically that person in the stock market that says, the price for Verizon should be X amount of dollars, and got it right about half the time and got it wrong about half the time. So my objective here is to help you guys get it right about a bit more than half the time. So I'm going to go through the basics of stock valuation. Very, very basics. But let's sort of introduce what financial markets are, right? I don't know how advanced any of you are. I think it's good to sort of take a step back and think about what financial markets do before going into sort of stock valuation. This is what people think the stock market is, right? Someone saying in a corner, I've got sort of a great idea that really excel, and then everybody starts shouting, excel, excel, and it becomes sell, everybody goes crazy, sells. Then on the other side, it goes into that's madness. I can't take it anymore. Goodbye. And someone understands buy, and then all around the financial markets go crazy and start going and buying, right? So just to like a little crazy iteration of what I hear on one side, I sort of repeat it to the other. There's like a broken telephone type thing, and then it goes into this wheel. So what we want to try and do is distance ourselves from this little wheel, right? And have our own view, not just do what someone else has told us to do a week later. So we'll probably end up losing money if we do that. What are financial markets for? So financial markets have four big parts, right? They have the investors. Those are the people who have the money, pension funds, mutual funds, hedge funds, all that type of thing. And they go to financial markets. Why do they go to financial markets? Because they want to make some returns off that money. On the other side, you have the companies, the governments. Those are the sort of the corporates that need the money. And they say, hey, can you lend me some money? I'll give you some more money in return. Okay. So there's the investors that have the savings, have the money. Then there's what we call the issuers, who are the governments, the companies, people who need the money. In the middle is the financial markets. It could be capital markets, money markets, a lot of different financial markets. We're going to focus today on sort of the capital markets part. And then intervening or intermediating in there are the brokers, the investment banks, and all the rest of the institutions who say, hey, I'm an expert in this financial market. I can help investors, I can help issuers, and I'll take some fees in return. Okay. So that's how it works. There's some savings, there's ideas, you put the savings where the ideas are, and you have some people in the middle who try and help intermediate that process. Here you can read in your own time, but that's basically explained. So there's two parts or two main sides of it that we care about in the capital market side for this. There's the equity markets, those are stocks, and then there's the debt markets we call bonds. Julian Alexander, what is a stock? What do you think a stock is?
A share of a company when a company goes public. So, retail people can own a part of that company.
Okay, but what is a share of a company? Do you get like the computer of a company? Do you get like I don't know, do you get like part of the offices of a company, or what do you actually get? What are you then?
A certain amount of their earnings, I guess you could say.
Okay, that's a good direction. So what you get basically, you're part of the ownership of a company, right? And as the owner, you have all the assets. Okay, so you're part of percentage of the assets, but also a percentage of the liabilities. What is the liability?
A liability would probably be, debt.
That's a part of a liability. Yeah, it's what the company owes, right? So you have the assets, you have the liabilities. So what the company has, what it owes, that sort of difference is the equity, right? So that equity is what technically you're entitled to. And that equity or that company generates certain earnings, like Julian Alexander was saying, and those earnings are also technically part of the ownership of, or they are the owners of the company have a claim to those earnings. Okay, so when a company is making some money and then they want to distribute dividends, if you own the stock, then you can get the dividends. Or if a company has a lot of assets and it sells those assets, technically you're entitled to a part of those assets when you liquidate that company. Is that clear? Hopefully everybody now participating in the stock challenge understands that they're buying and selling stocks and what that claim is. And that's very different now in this new world of sort of crypto and tokens. That's why I want to focus a bit on this to understand that you own a real thing, or you own a part of a real thing that is sort of asset, liabilities, and sort of a future or current earnings, right? On the other hand, debt is a lot easier to understand, right? I want to build a bigger factory. I say, hey, can I get some money in? I'm going to issue some debt, and I'm going to give you a 4% return every month or every year or whatever, depending on the risk of that company is, right? So that amount that you borrow is called the principal, and the amount that you pay investors is sort of the interest or the coupon. So very different investments, stocks and bonds, different. Which one is more risky?
Stocks, I would say,
Why?
out of stocks and bonds, because bonds are meant to be a safe investment because you're buying a company's debt. You get a fixed return. Stocks, there's no guarantee that you'll make money. It's the retailer's game.
Okay, that's great. And then, for example, when we're talking about these earnings or these revenues that the company is making, first you have to pay the bondholders, and then you pay the stock owners or the equity owners, right? So they have a claim, a priority claim to those assets and to those sort of revenue stream or earning stream. So that's also why bonds are safer investment. Okay, so let's make this a bit interesting. We've talked about financial markets, talked about trading, and people think about this as very far away from them, right? They're like, oh, look at this trading, look at these people in Goldman Sachs, look at these people at JP Morgan doing all this trading. I have no idea what's going on. But if you look at the data, look what's happening. So retail investors, you and me, hopefully people that are participating in this stock challenge are actually every time a bigger and bigger share of the overall stock market. If you look at here, Robinhood was almost like over 5% part of the whole market in just before January 2021. Okay, so trades in retail brokerage, so Robinhood, Schwab, E-Trade, TD, made up 28% of the US equity market. That's the peak that they reached, I think it was December 2020. So we're starting to matter. And that's interesting to know and interesting to point out, as we've seen in some certain stocks, right? I mean, you mentioned them at the beginning, and maybe that's not what we want to focus on right now in this class, but clearly retail investors are getting traction and being important. So don't think that if you're investing, you're going to completely out of the loop, because we are a bigger part and a more important part of the market that I've just explained. First thing, or the first concept in finance, is this idea of the time value of money. Okay? People sometimes are bewildered by this fact. Money actually depends on time, and there's a value to time. Why? Because pretty easy to grasp, right? What do you prefer? $1 million today or $1 million in 5 years? I don't know anybody who'd say that they prefer $1 million in 5 years, right? You want your money, you want it now, the sooner the better. So that was an easy one. But what if I say, do you want $850,000 today or $1 million in 3 years? Then people start thinking, okay, if I get $850,000 today, what do I do with them? If I get $1 million, will it be more than $1 million in 3 years, or would it be less than $1 million in 3 years, right? Then that's when it gets tricky, because there's some value to attach to earning some money. Why? Because the dollar received today is worth more than a dollar received a year from now, right? You can get that money, invest it, get some interest or get some returns on it, then have more money in the future, okay? So when we're looking at stock valuation, this idea of the time value of money is huge. I can't equate or say it's the same thing having $1 million today than $1 million in 5 years, because I can invest those $1 million and it'll be a lot more in 5 years. So when we're looking at the stock market does that every day. The stock market doesn't look at today, it looks at the future. And that's sort of concept number one that I really wanted to stress. If I start thinking about what the company is doing today, the earnings they're doing today, what the industry is doing today, then it's too late. It's too late. The stock market does is it looks into the future and says, okay, I think the renewable energy sector is going to grow. Let me see how much it's going to grow. I bring it into today and I decide if it's a good investment or a bad investment. Okay, that's the simplest way to explain this. So please, when you're investing, think about this. There's some value attached to time. Okay, so let's go on to, Warren Buffett. Hopefully everybody knows who Warren Buffett is. If not, you should definitely Google him. He's the most relevant or most important investor of the last sort of decade or two. I've created a link to the little video where he explains what all of us can do to invest. And I think it's worth the time. So Julian, Alexander, you want to play it?
The thing is to decide, is to be able to define which ones you can come to an intelligent decision on and which ones are beyond your capacity to evaluate. You don't have to be right about thousands and thousands and thousands of companies. You only have to be right about a couple. I met Bill Gates on July 5th, 1991. We were out in Seattle, and Bill said, "You've got to have a computer." And I said, "Why?" And he said, "Well," he said, "you can do your income tax on it." I said, "I don't have any income. Berkshire doesn't pay a dividend." He said, "Well, you can keep track of your portfolio." And I said, "I only have one stock." I said, I mean, and he says, "It's going to change everything." And I said, "Well, will it change whether people chew gum?" And he said, "Well, probably not." And I said, "Well, will it change what kind of gum they chew?" And not. And I said, "Well, then I'll stick to chewing gum and you stick to computers, you know." I don't have to understand all kinds of business. There's all kinds of business I don't understand. But there's thousands of opportunities there. I did understand the Bank of America, you know, and I'll be able. I'm able to do that. I'm able to understand some given percentage. But Ted Williams wrote a book called The Science of Hitting, and in The Science of Hitting, he's got a diagram, shows him at the plate, and he's got the strike zone divided into 77 squares, each the size of a baseball. And he says, if I only swing at pitches in my sweet zone, which he shows there, and he has what his batting average would be, which is 400. If he had to swing at low outside pitches, but still in the strike zone, his average would be 230. He said the most important thing in hitting is waiting for the right pitch. Now, he was at a disadvantage because if the count was 0-2 or 1-2 or so on, even if that ball was down where he was only going to bat 230, he had to swing at it. In investing, there's no called strikes. People can throw Microsoft at me and, you know, you name it, any stock, General Motors, and I don't have to swing. And nobody's going to call me out on called strikes. I only get a strike called if I swing at a pitch and miss. So I can wait there and look at thousands of companies day after day, and only when I see something I understand and when I like the price at which it's selling, then if I swing, if I hit it, fine. If I miss it, it's a strike. But it's an enormously advantageous game. And it's a terrible mistake to think you have to have an opinion on everything. You only have to have an opinion on a few things. In fact, I've told students, if when they got out of school, they got a punch card with 20 punches on it, and that's all the investment decisions they got to make in their entire life, they would get very rich because they would think very hard about each one. And you don't need 20 right decisions to get very rich. 4 or 5 will probably do it over time. So I don't worry too much about the things I don't understand. If you understand some of these businesses that are coming along and can spot things on, if you can spot on Amazon, for example, I mean, it's a tremendous accomplishment what Jeff Bezos has done. And I tip my hat to him. He's a wonderful businessman. He's a good guy, too. But could I have anticipated that he would be the success and 10 others wouldn't be? I'm not good enough to do that. But fortunately, I don't have to. I don't have to form an opinion on Amazon. And I did form an opinion on the Bank of America, and I formed an opinion on Coca-Cola. I mean, Coca-Cola's been around since 1886. There's 1.8 billion 8-ounce servings of Coca-Cola products sold every day. Now, if you take 1 penny and get 1 penny extra, that's $18 million a day. And 18 million times 365 is 7 billion, 3 less 730 billion, or $6,570,000,000. So annually, $6,570,000,000 from 1 penny. Do you think Coca-Cola is worth a penny more than Joe's Cola? I think so. So, and I've got about 127 years of history that would indicate it. So those are the kind of decisions I like to make. And you may have an entirely different field of expertise than I would have, and probably much more up to date in terms of the kind of businesses that we're seeing evolve. And you can get very rich if you just understand a few of them and understand their future.
Mr. Buffett saying that we just need a few ideas in our lifetime, right, to invest. And if we thought through very well those ideas, then we'd make sure we get them right. So that's what I'm asking all of you to do, right? We understood that we're thinking about the future. We understand that we have just a couple of good ideas to have. And there you go. That sort of gets us in the right framework to think about stock and stock investing. So this leads us to market efficiency, right? If we think the stock market is already looking at the future and it already knows everything, then how am I going to make any money? Because today's price already reflects everything that's out there. So I can't beat the market. And if I can't beat the market, then I'm always late. And that means that there's no point investing actively. I can just invest in an ETF, or I can just invest passively and say, I want to track the stock market and forget about it. That's actually a pretty good idea for most investors. But if you're here, means you're interested in doing a bit more than that. So let's try and see what other ways we can do, right? So this efficient market hypothesis means that it's impossible to beat the market. The market already reflects everything or all the information that's out there. And when we think about the market, what we should think about is a lot of people with different ideas, something you should buy, something you should sell. And at the end, we end to a price, which is the equilibrium of both ideas, right? Market isn't like uniform. There isn't one idea. It's different people buying and selling that reach sort of equilibrium through the price. So market is all of us. So what we need is superior information or insights to be able to make some money in the market. If not, like, the easy money's already been made. We're never going to beat professionals with the easy money. Okay. So where do you think differently from the market? What do you think, Julian, for example? Let's make this a bit more interactive again.
Think differently than the market.
Where do you think the world is going to be in 5 years? Are we going to be in the metaverse?
In 5 years, I think the metaverse will be significantly developed, but I think the matter of efficiency markets won't change at all. And I
Okay.
think it actually it might be a little bit worse.
What do you mean with that?
I think due to the lack of, I guess, education within responsible investing could, lead a lot of people to just not understanding the proper way to invest and just putting their money out there and praying it will go up.
Okay. Okay. So then you're showing an idea of saying, hey, I think there's going to be a lot more savings and a lot more investors, but they're not going to be very sophisticated. So maybe there's ideas of where you can invest. You could invest in Robinhood. That's definitely the easiest place to put the money, or Coinbase, or any of the other sort of apps that are going to channel all this future investors that you're talking about. That's already a good place to start, right? But how do I know where to go after that, right? So how do I pick a stock? That's why Julian Alexander sort of invited me. Hopefully by the time we finish, we'll have a better idea of how to think about that. What's more expensive? Everybody out there, what do you think? So Amazon now is trading at $3,162 a share as of, I don't know, like 4 p.m. that I checked this. Tesla, on the other hand, is trading about $1,000 a share. Is that cheap? Is that expensive? What do you think?
I would say that Tesla is more expensive comparative to
So,
each company's
so
valuation, financial
Julian
valuation.
Alexander's cheating already. He knows the answer and he knows where I'm going. That means he actually listened to my class over the summer. That's good. It's good. I also invite all of you to do that. But if you basic knowledge, and I hear it all the time. I'm out there talking to friends, my age, my background, college educated, master's degree, and they're like, wow, Amazon's so expensive. It's $3,000 a share. I'm like, that doesn't really say anything. Like the price really on its own doesn't reflect anything. And then they go, of course it does. Look, Amazon's doubled or tripled actually over the last 5 years. So if you look at Amazon on the left, they've went from about $1,000 in 2018 to about $3,000 now, right? So they multiplied by 3, and they think that means it's expensive. If I go and I say, well, Tesla's only at 1,000, but it actually multiplied by 15 times since 2018. It was like $70 a share, and now it's at $1,000 a share. So which one is more expensive now? I still can't know. I still can't know because yes, it's gone up, but maybe there's reasons why, right? Why it's gone up. What reasons could that be? What do you think?
Well, I think with the current state of the market, I think news plays a lot in stock increases, and I think social media presence.
Okay. Okay. So you're saying one's got hot or it's got popular. Um, that's a big part. And that's going back to here where we're talking about efficient markets, or even here, right? This goes all the way to our first slide where we're saying sell, 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 buy, 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 buy. I just do what I just heard, but we're better than that. So yes, we have to be careful with that. Let's go and actually think about it. What does expensive mean? It doesn't mean that the stock price is high. It doesn't mean that the stock price has even gone up a lot lately. Those are relevant factors and they're part of it, but there's also something behind that, right? And that's sort of what fundamental analysis tries to understand. That company like Amazon or Tesla might have been making $100 of profit and now it's making 1,000. So before, as the equity owner, right, we're entitled to that money. Before, let's say I had 1% of the company, they made $100. I had 1%, $1 of that technically was mine, right? Now the company is making $1,000. I still have 1%. So how much is mine? $10, right? So I used to have $1, now I have 10, but the stock has only gone from 1,000 to 3,000. So it's only gone up 3 times, but my money has gone up 10 times. So technically, stock's cheaper for me. I'm making more money off that. How do we frame that? It's a concept called price to earnings ratio, or PE ratio. And that's the most, or the easiest starting point to understand if a company is expensive or it's cheap. So that measures the current share price relative to its earnings. And maybe I should have started a bit slower. In how do you get to a company's earnings? Like, what are earnings? So the company makes some revenues, right? Selling some products, or if it's Facebook, selling some advertising, or some intangibles, like Tesla selling some cars. But it also has some costs. So if you take the revenues, you take out the costs, and then you take out sort of all the taxes that it has to pay and the interest on the debt, at the end, what you get is the company's earnings. Okay, so please also don't sort of get lost in those two concepts. Some people talk about revenues as if they were earnings, and earnings as if they were revenues, but revenues is sort of the top line, the beginning, and you take out all the different types of costs, and at the end, what you get is the earnings. Okay, so if I divide the price, or the share price of a stock by the earnings, I get this idea of a PE ratio. And the PE ratio will tell me if some stock is expensive or it's cheap, because it measures that price that we were talking about at the beginning with how the actual fundamentals of the company are doing. So it's not only the price, but it's also the operations. And that's the easiest and the most simple way to look at if something is expensive or it's cheap. And then, as Julian Alexander mentioned and was correct, Tesla is actually a lot more expensive. If you look at this ratio, Tesla is trading at about 200 times P ratio, while Amazon is only trading at 48. What does that mean? If I was the owner of Amazon, it'd take me 48 years of earnings to get to the current price. Versus Tesla, it'd take me 200 years of earnings, these current earnings, to get to the stock price. Think about it that way. That's interesting, right? If I'm the owner of the earnings and I'm paying for the shares to get my money back, I'd have to wait 200 years of earnings. Who waits 200 years of earnings? You guys expecting to live 200 years to get your earnings back when you invest in Tesla on Robinhood, or you're not? I mean, maybe your generation probably going to outlive mine. Okay, so then why would someone buy Tesla? And move or take aside all of the social media presence, all the buzz, and all the rest of it that Julian Alexander was saying. And he's correct, but that's class 2. This is class 1. Why would someone buy Tesla then?
I would say that a potential investor would look at Tesla not because of their current value, but their potential value of producing more cars and ruling the EV industry, and how much potential it has to grow.
That's awesome. That's awesome, because lesson 2 for today is the P ratio, but lesson 1 was time value of money in the future, right? Stock market's going and looking into the future. So actually, Tesla used to sell, I don't know, whatever many number of cars, but it's predicted to sell twice as many next year, 3 times as many the year after that, 4 times as many, right? As the EV market grows, as their supply chain issues get solved, as electric batteries get better. So what the market is doing is saying, hey, let's look out there and see, well, Tesla might be selling X amount of cars today, but it's definitely going to be able to sell 3 times as many. And therefore, my earnings are going to grow three times or even more than 3 times. So they're already pricing that in. How do I put that into a number again? So Price to earnings ratio is a good start, but what's even better is this idea of the PEG ratio, price to earnings growth. And again, we're talking about sort of fundamental stock market and stock market or stock picking and long-term sort of investing, right? Maybe the P and the PEG ratio at the short term doesn't work, but in the long term, it usually is a great way of sort of screening companies. What does that do? It divides the P ratio again by the growth rate in earnings, okay? So that allows us to compare companies with very different growth rates to see if they're expensive or they're cheap. That way, a company like Amazon can be compared to a company like Tesla or even to a small startup company. They're all on the same ratio. PEG ratio works for the three of them, okay? That's the best starting point. Let me pause there for a second. So here's a bit of a description of the PEG ratio that everybody can read in their own time. Last part, there's one more thing to think about, or there's a lot more things, but one more basic thing to think about, and it's a catalyst. Okay, so I might have thought about the future, chosen very well where I think the world's going to go, looked at valuation and said, hey, it's actually, I think there's some opportunity here. It's not too expensive. But then why would the market, who's thinking one way, start thinking the way I'm thinking, right? If I could be right, but I can die being right and the stock market still hasn't proven me right, okay? I don't know who's seen the movie about the financial crisis, about this investor in mortgage-backed securities. I think it's called, is it Boiling Point? What is it, Julian?
I think it was called The Big Short with Michael Burry, 2008 crash.
Okay. And they were right, and they were right, and they were right, and they were right, but the market wasn't realizing that they were right yet. They almost went bankrupt before they knew the world realized that they were right, okay? So I'm going to use a case or a case scenario that that sort of resembles what's happening today and leave you guys to think about how this could impact today. So the price of oil is now in the FT every morning. No one cared about the price of oil for the last 3 years. We were going green. Renewables was awesome. Price of oil was between $40 and $60 a barrel. No one cared, right? And suddenly, global financial crisis due to COVID, price of oil even went negative. And now we're seeing it above 100 again, right? So fluctuated. So that acted as a catalyst for 3 shares: ExxonMobil, oil company; American Airlines, so airlines; and then the actual oil price, right? Or the Brent. This here is how the Brent went. So 3 stocks out there. Which one do you think is each company or each idea? I'm going to help you guys. The one at the bottom, obviously, is the price of the oil, because that's the one that fell. So that's the easy one. But then which one's the one on the left and which one's the one on the right? So what would you expect? What would you expect to happen?
I would expect the right one to be American Airlines, the left one to be maybe Exxon.
Okay, so American Airlines, what does American Airlines use oil for?
Air travel.
Okay, so you need it to fuel up your airplane. Surprisingly, American Airlines actually buys oil into the future, right? So it already hedged some of that risk. So American Airlines is the one on the top left.
Interesting.
And then the one on top right is actually ExxonMobil, who benefited originally from that rise in the oil price, but then flatten out. Okay, so be careful how the catalyst works. You can see below, if you actually cheat, the bottom left of each chart has explained what company it is. So ExxonMobil, top right, top left, American Airlines. Okay, so that's why you also have to understand the operations of the company. American Airlines, you think, oh, wow, it's going to be terrible or going to be great. And then they actually hedge most of that risk out. So careful. But going back to my point, sorry, I'm deviating, is there's certain actions or certain moments that act as a catalyst. You could say for the music industry, suddenly you had Napster and everybody was sort of copying and no one was actually buying music rights. Music industry was dying. Then Spotify shows up, Apple Music shows up, music in the metaverse shows up, and then the music industry pops back up again. Now we're seeing the movie industry going through a similar transition, right? The people are watching certain Oscar movie films in their own house and the experience is a lot worse. Does that mean that it's the end of movie theaters? We don't know, but that's a good thing to think about and say, what can act as a catalyst for the market to understand my idea? Okay, this goes back to the framework. There's no real good or bad stocks, right? There's only good or bad prices to get into. So be careful when you're buying. If we go to the beginning and we buy when we heard someone else say buy, we might be buying at the top and it might be too late. We saw Netflix falling double digits today because they posted for the first time negative sort of subscriber growth. Great company, great product. It's been a sweetheart for the last sort of years with this FANG idea. Everybody thought with the pandemic it was going to be great. And then suddenly negative subscriber growth as we get out of the pandemic. Nothing really changed between yesterday and today, but it's a completely different stock. And I don't have to repeat this to you, and it's the most obvious and hardest thing to do, but obviously we try to buy low and sell high, right? Okay. So there's a risk return inherent in all of this. There's an opportunity cost. You have some savings. You can put it in Netflix, or you can put it in Google, or you can put it in Tesla. You don't have infinite savings, and they have different types of risk. If I'm going to go in and invest in a biotech company that has a very high risk, I'm expecting a high return, like the crypto market. If it has a very low risk, like Julian Alexander was talking about bonds, then I will accept a lower return, right? If I can just buy a bond, I know I'm getting a coupon of 4% every month, then that's perfect. I'm happy, I'm safe, it's a safe company. But if I want to go out and buy a biotech company or a startup or a tech company, then I'm expecting the return to be high too. So don't only look at the return potential in the company, but also you have to look at the risks. What's the downside? If I get it wrong, where can this go? Where can I get it wrong? What's the data telling me about my assumptions? And that sort of leads us to the end of this presentation, which is sort of how do I look about fundamental analysis, operations of a company, and how to invest. I need to create a small little framework that I can follow, almost like a checklist that I can follow to see if I'm okay. And that framework, what it does is allows me to check the assumptions that are behind and make sure that the new data matches my assumptions, okay? So that helps us be structured and organized and not sort of invest just on what we're hearing and what we're seeing and what's hot and what we read on Discord or any other platform, okay? So 4 easy tips that I'm gonna help or send to you guys when you're looking at long-term fundamental analysis, which is, where do I think differently from the market? Where do I see the world in 5 years? Don't try to be an expert, as sort of Warren Buffett is saying, on things that maybe you don't understand. Every day we do things. I don't know if Julian Alexander plays on Fortnite or plays or sport fan or whatever he is, but I'm sure there's something he understands better than I do. Even if I 24 hours as an investor and he is probably longer than me as an investor. But anyway, where do I think differently? Where is the world going to go? Do I actually have an angle? Because it's something that I know that the world's going there. And all of you as young people, probably better suited than I am at this. And that's sort of what Warren Buffett is saying when he missed some of the big stocks because he didn't understand the tech industry. He's famous for not investing in tech. Two, let's look at the valuation. Let's structure this. Let's not just look at a stock price and think about valuation. Let's actually look at the operations of a company, the fundamentals, the earnings it's creating. What are these earnings going to do in the future? Where do I want to go? And say, is the future that I expect already in the price, or is it not? If it's not in the price, second check. Third check. What is going to change? How is the world going to come to my idea and not my idea be a disaster and the world being right? Okay, where can that catalyst come from? Obviously, you can't forecast a pandemic. You can't forecast sort of an oil crash, but you can definitely understand certain data points that make you look at your assumptions and see if you're correct or you're not correct. I think Netflix is going to come back. Okay, so I can check next month's subscribers. I can look at my friends and see if they're getting Netflix, see if Netflix is changing prices, stuff like that. And then look at the risk reward, right? I don't want to take a huge amount of risk if the reward isn't worth it. So make sure that that risk reward of where I think the world's going to go, where I think the price is going to go, where I think the stock is going to go is worth it. I don't want to invest in oil at $110 a gallon if I think it's dollars a barrel, sorry, if I think it's going to go to 120, because the probability of me making $10 is high, but the probability of the oil price going back down to 80 is also pretty high. So am I going to get that little last margin and take all this risk? Probably not worth it. So those are my sort of 4 points for fundamental long-term analysis of stocks without going too deep into sort of accounting or valuation. But happy to answer questions on that if there is that level sort of in this game.
All right, awesome. Thank you, Mr. Gonzalo, for that in-depth explanation and exploration of fundamentals and also stock valuations. Let's get into some Q&A. I will keep it simple and short because I know your time is valuable. First question from one of our members. She said, what does it take for a company to have a great valuation in its stock?
So valuation or a great valuation can mean many things depending on what type of investor you are, right? There's investors that like, or what are called value investors. And value investors, what they like is very low P ratios, very low valuation metrics, and saying companies, hey, this is a company that the market thinks is pretty bad. I don't think it's as bad as that. I'll invest in a low P ratio. Or I think the company's price has fallen a lot and the P ratio has fallen to be very low. I think it's going to recover and go back to the normal, right? That'd be a good valuation for a value investor. If I'm a growth investor on the other side, for example, I say, hey, I think that Ford is now going to make a lot more EV cars. So maybe my valuation is now as a regular car company, and that valuation is going to move higher into a valuation closer to Tesla. I say, hey, I think my P ratio was 10, it's going to go to 20. So I see there's a growth in that valuation. So when you're looking at a great valuation, it's not the number, it's sort of where that number is going to, where you think that number is going to, right? I think the market is valuing this company to be very bad at 5. I think it actually isn't at bad, it's going to return to 10. That's great. Or I think this company is already valued at 10, but I think it's going to be Tesla, so it's going to go to 20. Or the other way around. I think Tesla's at 200. That's definitely not sustainable. I think it's going to go back to a normal car company level and go to 50 or 20. And I'm going to short that company, right? So we look at valuation not as a number on itself, but as where do we think it's going?
Interesting. All right. Another question. is it possible, he said, is it possible to use fundamental analysis for short-term trading?
So it's possible, but and without going too deep, it's possible, but what we're doing there is we think there's a catalyst. So for example, in earnings times, I can do my homework, I can look at earnings, I can look at fundamentals, I can look at P ratios, and I can look at sort of earnings growth. And since I know there's a catalyst, which is the company's going to report earnings, I can make some money there in the short term. For example, banks when there's monetary policy decisions, or cars when they're going to report sales. So I need to have a catalyst where my sort of long-term analysis or fundamental analysis meets that sort of technical point or that catalyst that drives that value. That's possible. I think fundamental analysis is better suited for the long term and for sort of planning ahead and take time. But there is ways that both worlds sort of meet, or there is places where both worlds meet.
All right, awesome, very interesting. And one last question we have. He asked, do you believe that fundamental analysis can be shaped in the form of algorithms, just like trading strategies are?
Yeah, definitely. They're already happening. So if you look at all the big value investors and all the big sort of fundamental analysis investment banks, or not investment banks, but sort of investors, their first thing is a huge algorithm that screens all the equities out there to see which one looks good on their metrics. So I have a algorithm that says every company that has a PE below 5, I want to see it. That's an algorithm. Another one is every company that's had a PE fall more than 20%, I want it. So there's definitely ways that you can bring in sort of automatization into a fundamental analysis. So you have the framework, you set certain limits, and then what you have is sort of a screener that goes out, links into Bloomberg or whatever platform you have, and spits out ideas. And then you get the idea and you can decide if you want to invest or not. But it's definitely step number one for a lot of these big investors, because you can't follow the stock market, all the stocks every day on your own, right? You need some way to screen what's relevant or not. So those are two big ones that come to mind. When P ratios or certain valuation metrics fall below certain levels, or when the actual P ratio changes to a certain level, or when stocks sort of increase or fall at certain points, and there'll be like alerts that I'd get and start looking at those stocks. Maybe even not even stocks, but start with sectors, for example. That's probably easier, and then you go into stocks.
All right, awesome. Well, that about wraps it up. Thank you so much, Mr. Gonzalo, for your time, and also for your knowledge and all the experience you have in Wall Street and finance. We really appreciate you sharing this with everyone.
Of course. If anybody has further questions, I'm sure you can contact me. I'm on that Discord channel myself, and if not, I'm sure Julian and Alexander can get the questions over. So hopefully this has been helpful and not too easy or too hard for everybody to follow.
All right, awesome. Thank you.